Warm welcomes actually from Frankfurt, not from Cambridge. Everybody of us is sitting around a European table here. And what we are doing is what we did in this European Economic Policy Forum for meanwhile over 6 years, which I co-share with Dante Roschini. My name is Hans-Helmut Kotz. What we try to do is to discuss important European policy issues as they arise. And to throw them around and to assess them critically. We do have a very topical issue today, the fiscal financial architecture of the European Union. Very topical because actually today the EU Commission came out with its spring forecast. That's an exercise which they do twice per year. And one topic in that spring forecast has been the Recovery and Resilience Fund. This is the major European effort launched last year, which is about trying to help European economies to recover, that is, get back to where we started before the pandemic hit, and then to create the foundations for lasting growth. The initiative has a 750 billion envelope, so really substantial. And it is to a large degree comprised of grants. This should deal with the uneven fiscal capacity across the member states of the European Union. So some member states will really profit very significantly. Incidentally, the largest chunks go to Italy and Spain, and they've already submitted, as everybody else, submitted their programs to the EU Commission. And the emphasis in these programs will be to support structural reforms. We will discuss what we mean with structural reforms, to increase capital expenditures, to provide economies with better infrastructure, better machinery, better tools, if you like, and also to transform European economies to more climate risk conscious and environmental policy conscious context. So two major criteria for the deployment of the funds had to do with digital and with greening. We have a fantastic panel here. I will only very briefly introduce them. You can find a link on their CVs on our webpage. Otherwise, it would take basically the whole webinar. So the first is Thomas Sarnheimer. He is, I'd like to call him the most important civil servant in Brussels, meaning that he is in charge of chairing the group of finance ministers which are members of the European Monetary Union, i.e. 19 member states. But he's also chairing, in that case, it means finding common ground amongst all economics and finance ministers, and central bankers actually also sitting in these meetings of the Economic and Financial Council, which is just on the opposite side of the street in Brussels. That's the representative. Those are the representatives of member states. In a previous life, he knew that all. He was involved in all that as a permanent secretary in the finance ministry of Finland, and before that, he got a solid grounding in central banking. So he was head and chief economist of the Bank of Finland. Our second panelist is Laurence Boone, who's worked so much on European issues and written so many articles, actually also a book on European monetary policy. And she's been involved in 3 areas strongly. So one is academia, where she taught at the most renowned French schools, Sciences Po, less known, but at least as renowned, Polytechnique, barely known, at least as good, and SAR, and so forth. But she's also worked very practically in mainly investment banking and in politics. So she was the advisor to, or Sherpa, to French President François Hollande during a very difficult period. And now she is, for about 3 years, chief economist of the OECD. And actually one can read it in reading the economic outlook that she's involved there. And finally, not last, of course, we have Elena Kaletti. Elena has submitted her second doctoral thesis at Mannheim University. I have to mention Mannheim, Elena. I shouldn't do that? You didn't tell me. And Elena...
but it was my habilitation, Hans Helmut.
I know, I said second...
second doctoral in that sense, okay.
So, Elena has been very successfully establishing a fantastic seminar on banking and finance at the Florence School. She is full professor of finance at Bocconi, but she is also very practical. So she has been on the board of UniCredit, which is the largest Italian bank, for 3 years now. So very much involved with the microeconomics, the details, the firm level issues. And she has so many accolades in academia that I stop exactly here. So now we start. I would ask Thomas to give us a background on how European fiscal policy mechanics somehow work. Thomas.
Right. Thanks, Hans Helmut, and good day to all the listeners. So Hans Helmut suggested that I would touch on topics such as the COVID response of the European Union, recovery and resilience facility. I think Laurence and Elena will be touching on those topics, and I leave it to them. I can respond to questions if necessary on those issues. And I use my few minutes to mainly concentrate, or entirely concentrate, on the issue of the fiscal framework in Europe. And as you may know, the European Union is about to engage or re-engage into a big discussion on the fiscal rules, fiscal framework that will then guide the fiscal policies of European member states for the times to come. So the first question, why now? And there are two answers to this. Well, the first one is a bureaucratic reason. In the legislation, notably in the 2-pack and 6-pack legislative packages, there is a legal obligation to perform a review at the 5-year mark. That 5-year mark has now passed. And if you're wondering what 2-pack and 6-pack legislative packages are, there are the 2 packages of secondary legislation that make up the Stability and Growth Pact and specify the general fiscal rules and procedures that are in the EU treaties. So in fact, the review of these rules was already launched in 2019, but it was interrupted by the pandemic. And we are now sort of expecting the review to be relaunched in a matter of maybe half a year or so, but that's a guess. So that was the bureaucratic reason. The political reason that there is what I would characterize as a fairly broad dissatisfaction with the existing setup. There's a lot of criticism coming from various directions. I mean, one of the biggest sources of reasons of criticism is the complexity of the framework. There's also criticism that it's simply outdated, that the limits and rules don't correspond to the real world that is around us right now. And a third source of criticism is that the framework hasn't been implemented, that the rules have not served their purpose and sanctions have never been used. Now, saying a few words on each of these sources of criticism regarding complexity, that's in a way undeniable. It is a complex set of rules. It's built on several variables, many of which are unobservable, like potential outputs. And you can understand that when you are basing rules with potential financial sanctions on non-observable variables, it tends to get complicated and difficult to predict. And the package actually covers not only these legislative elements that I mentioned, 2-pack and 6-pack, but also sort of third-level regulatory texts called vademecum on Stability and Growth Pact and Code of Conduct. Altogether, hundreds of pages. So very few people really in Europe understand the framework completely. And it's quite difficult to predict when it's time to do the budget, to predict what the rules will entail for the year for which the budget is being prepared. Now, why is this complexity? Why did we get there? Why did we build such a huge net of rules? Well, first, because fiscal policy is complicated. Situations vary, and simple rules typically don't apply, are not appropriate for all kinds of circumstances. So with the framework needs to be able to deal with exceptional situations, prevent counter-cyclical policies in recessions and so forth. And this needs to happen either through discretion or through additional rules that govern the exceptional situations. And the reality is that member states opt for the latter. So they did not want to grant the European Commission the discretion to bend the rules or provide flexibility, but instead they made the effort to create a new rule for every eventuality you could imagine, and that over time added up into a highly complex framework. Regarding the rules being outdated, well, you are aware of the two treaty-based goals, 3% for deficit and 60% for public debt, gross debt. Now, looking from the perspective of today, the debt rule looks quite unachievable. And this is where the most criticism has been, that 60% is not commensurate with the realities of the day, and that the concept of sustainable debt has changed. And this criticism is mainly based on the observation of very low levels of interest rates, very low levels of debt servicing costs, which it is concluded has made the sustainable level of debt higher than the 60%. Now, I'm not going to take a position on this one. I shouldn't, because I'm supposed to mediate the discussions, but I would say that it's probably too early to assume that the low real interest rates we see today are permanently with us. So this is all I want to say on that. The final criticism that I mentioned was the poor implementation that some see. So here people refer to the fact that excessive deficits have prevailed for decades. Some countries have spent almost the entire time of the euro with the deficits above 3%. There has been little convergence of public debt levels towards the treaty level, target level of 60%, and the sanctions have never been applied. So these are the sources of criticism. So let me end my opening words with some personal views. First, I'm personally skeptical whether any redefinition of the numerical rules would overcome the difficulties of implementation and bring about sort of harmonized view on what fiscal policies ought to be. I don't see this primarily as an exercise in redoing the numerical rules. I see this as a broader issue. The difficulties that we are facing are sort of pretty easy to understand. What we're doing here is restricting the budgetary sovereignty of member states. No country likes, no government likes to be told to reduce expenditure. It's always going to be a loaded subject and a highly political subject. And there are no numerical rules that would depoliticize the issue. What I think we should benefit from is a little bit of thinking in a way of a reality check regarding the expectations that we want to set on our fiscal rules. I think it always was an illusion to think that there could exist a set of numerical rules that are just blindly imposed by the union and enforced by the threats of sanctions. In a way, the whole idea of imposing sanctions on a country that is already in fiscal trouble, by definition, it's quite counterintuitive, and that's why it's hardly credible. And deep down, that's why it's never been done, because it doesn't make real sense. So that's why I like to talk more about the fiscal framework than fiscal rules. It's a broader framework that we should be thinking about. A framework that helps countries to internalize the idea of responsible fiscal policies, transfer it from something imposed through European rules from the outside on countries, and make it part of their countries' sort of own fiscal debate. I think we should put far less emphasis on sanctions and more emphasis on things like the honesty of the union assessments and the visibility and openness of the discussions they generate, discussions on fiscal policies. If the union disagrees with a country's fiscal policies, this disagreement should be visible. It should be visible to the citizens of the country, and it should generate discussion within the country to ensure that the government is held properly accountable for its fiscal choices. And I think, I mean, I'm not one that considers fiscal framework a failure. There are actually a number of countries where the experiences are quite good, and those I think are primarily from countries that have successfully internalized the EU fiscal rules in their own domestic procedures. And in a way, these countries have decided to use the EU fiscal rules as a focal point to guide their own domestic fiscal debates. In a way that the fiscal rules play a role not dissimilar to the self-imposed debt limits that the states in the United States have set for themselves. And I think this should be the main goal of the EU framework. Try to help more countries to internalize the rules. And this is a broad horizontal effort. It's not only rethinking the rules as such. It's very much about the communication of the recommendations. It's about fiscal procedures. It's about the existence of fiscal and role of fiscal councils that have been established over the recent years in many countries. It's about the Budgetary Framework Directive, which is another key piece of legislation that obliges the countries to have clear medium-term budgetary plans without questioning the ownership of those plans. And I would hope that that sensible rules, together with good budgetary procedures and comprehensive independent information made available to the citizens and to the media for country, this would over time help to build sufficient societal and political support for responsible policies in fiscal policies in each country. This is where I would like to end. And as I said, whatever I did not say, I'm ready to discuss later. Thanks.
Thank you very much, Thomas. That was very inspiring because it was in a very concise way describing where we are now, why Europeans are dissatisfied with the current framework, in particular complexity, but also never obeyed basically in many places. But then you turn to an argument which I do think is now at the core. The French Conseil d'Analyse Économique, incidentally, made a rather similar point in a recent contribution, Xavier Rago and colleagues, where they argued in favor of a framework, not so much rules, as you did, but in particular also insisting on ownership, not being inflicted from above, but decided upon, if you like, bottom up in a debate in the appropriate context, the national one, because then scapegoating isn't feasible anymore. And it is also important, and I really like the point you made there, what you now call fiscal boards. The Centraal Planbureau in the Netherlands, for example, has been conducting similar work along those lines, independent, also taking care of forecasts. So rationalizing the legitimate debate within countries, because it's ultimately about budgetary sovereignty. So thank you very much for this perfect background which we now have. I now hand over to Laurence. Si je peux.
Of course, Hans-Helmut. I just need some guidance from you because I thought from the question I would.
You take the questions I gave you.
Okay. So let me start by saying that I really appreciated as well what Thomas was saying. I think it makes a lot of sense, and that's something we've also been trying to push, including because fiscal policy touches on so many aspects of distribution, redistribution, and allocation that it needs a bit of a democratic backup behind. Having said that, okay, so you asked me the question. One is to give a little of a global context about how the crisis has been managed, and then what we see are the challenges looking forward. So I'll start with the first one, and I will step out of the EU only to focus a little larger than this. And I think it's really fair to say that hopefully we're entering a better period than what we had seen so far. And that is largely due to the absolutely amazing monetary and fiscal policy support that we have seen in many countries, and not only advanced economies for that matter. And those huge and very rapid monetary and fiscal support have allowed to preserve firms, jobs to a large extent, and the fabric of our economies. And when we compare this with the financial crisis, it's an amazing progress. So the first thing I would say is all countries learned a lesson from the financial crisis and have been able to put in place very supportive policy. Having said that, obviously the recovery is very uneven, and that's across the world between advanced and emerging market economies, but it's also the case within the EU. And we are seeing some countries much more affected than others. And that depends on a bunch of factors like, how soon they were hit by the crisis, by the virus, I mean, more than the economic, how they've managed it from a health point of view. And within Europe, not specifically differences in deploying amount of support, but I think that there were some differences in the way that this support has been put in place. So let me get a little into this now. So whether it's in Europe or other advanced economies, and again, to some extent, even in some emerging market economies, we saw that the support has been to protect people, income or jobs, and I'll come back to this, to protect the firms and to ensure some level of demand. And if we stop there for a minute, regarding the jobs, I think one of the main difference between Europe overall and, for example, the US, where some of you are seated, is in Europe, it's the job retention scheme, which have been massively used, meaning that the worker keeps the contract with the firm and the state or the government pays the firm, which in turn pays the employee. So when the economy reopens, then people can get back immediately to employment, at least those who have a job, of course. And that's important to note because self-employed don't have this. Now, in the US or the UK, we're talking about furlough scheme, and here we're not preserving the link between the firm and the people to the same extent, but the state is paying directly a sum of money to the person who's unemployed. And again, that's different. If I had to point to an advantage of this is if demand is booming in a new sector, in a new area, then some people can move very quickly to this new sector or new area. Now, when we look across European countries, even if most of them have used these job retention schemes, there are important differences, and I think they will also make a difference in the recovery. Let me just quote one. In Germany and France, the maximum that the state contributed to the salary of a worker could go up to close to 8,000 euro a month, which is a lot of money, right? By contrast, in Italy and Spain, it was capped at about 1,500 euro. So you can see that the amount of savings or how the well-being or life of people was preserved is very different. Then there is the corporate support. And here again, I was very much in agreement with what Tomasz said. One of the things which we have missed to actually be able to analyze what was happening in Europe with other countries is to have comparable data on the way that countries were supporting their firms. And as all of you around the table know, there has been huge amount being announced. And actually sometimes you could even think, wow, there's going to be a race to the bottom because governments want to show that they are effectively supporting their firms. So huge amounts of support announced. Some of them were grants, subsidies, others were loans or guaranteed loan. And again, that will make a difference in the recovery. If you're a firm with a very strong balance sheet because it has been strengthened with grants, then you will be in a position to invest in a better way than a firm which has been supported by loans and which is highly leveraged. So that will make a difference, and we see differences across countries, but I'm sure Elena will have some things to say about this. It has also been the case that some countries have banned insolvency for some months. And obviously that triggers the issue of what happened when this ban is lifted. So that's, I think, are the main point in what happened. But again, I think we should be, I think Europe's been impressive given the complexity of the governance that you get a glimpse of regarding the fiscal rules, thanks to Tomasz, the ability to put in place, to lift stated rule by the Commission, to lift the deficit rule, and to let countries implement massive fiscal support through job retention scheme and corporate support has been amazing. And the reaction of the ECB has also been a lot faster than in the financial crisis. So now the results, since it's difficult to compare the numbers regarding the support, the result is uneven, as I said, and I think it's important to highlight that, for example, some country like Spain, very sensitive, very dependent on tourism, and who's been hit relatively early in the crisis, has lost about 2 to 3 times more output than a country like Germany, which was hit later, possibly managed differently, the health crisis, and is more specialized in manufacturing. So in a way, effectively divergence has increased in the EU. The Next Generation EU, the fund that has been put in place and that I had not mentioned yet, but Thomas can explain the intricacy of this very quickly, is the first time that Europe is using a tool to actually diminish or reduce some of the divergence, and that's super welcome in the context that I have described. The next question, obviously, is all this enough, and what happens when you reopen the economy? So let me go quickly here and make 3 points. And before the 3 points, one thing I would say, there's a lot of question about should Europe go Biden, right? Biden, the new US administration's having an American risk. There was a 1.9 trillion, then we had the American Rescue Plan, then we had the American job plans, and there's the American Family Plan. And I think the first thing to really get straight is that there's a huge difference between the initial situation of the US and that of Europe. Europe has large automatic stabilizers, so automatically somebody who gets unemployed gets a replacement ratio which is quite high. There's a larger coverage, larger healthcare coverage, larger, for example, medical leave benefits nearly everybody. So the initial situation, the initial social protection is much higher. Therefore, the needs for this in a crisis are lower. And I think it's important, again, to keep that in mind. And we can dig further into this later on. And so the question may be, do we need more, or do we need now that we're recovering? But I don't think the benchmark should be necessarily what the US is doing as a whole. And also one thing to keep in mind is the US is opening its economy a lot earlier because they have started vaccinated quickly. And it may make sense to add money when the economy reopens, but at the current juncture, given the extent of the protection in Europe, adding money now that economies are not reopening yet, might not be a good thing. So we might do, and that's something I would like to discuss, and move to some state contingent type of form for deciding to add more. So sorry for this US little point. So 3 things. First, I think there needs to be enough continuing fiscal and monetary support so that demand does not falter. So that firms can actually adjust their production of goods and services to new choices and habits. If support is withdrawn too quickly, if that leads to weak demand, then we run the risk of having a crisis which goes from just a restricted amount of sectors which cannot work properly, much larger to the rest of the economy. So continuing demand support, I think, is important, ensuring that it is even, that people do not, and that firms and consumer can actually invest and consume. The second thing is, I think we need to accompany firms and people, and that means 2 things. The first one is it's about deciding on the sequential and progressive withdrawal of support for firms and for people. And that's where the OECD countries' experience become handy. Quite a few countries have some sort of state contingent approaches or some kind of fiscal forward guidance, like usually monetary policy has. And let me quite a few: Australia, Canada, or Israel. So you can see that they're different, but not so different from Europe. And what they do is they link the change in fiscal support altogether to employment data. So for example, Australia has committed not to tighten fiscal policy until unemployment has come down to 6%. Israel has some sequential targets. So they reduce the amount of support to people who are in partial unemployment or job retention scheme according to the rate of unemployment in the economy. So they can withdraw, I'm not sure about the number on this one, but about 10% when the unemployment rate fall to 10%, and then another 25%, again, don't take the number for granted, it's just an example, when the unemployment rate goes back to 7%. So this approach, which was announced ahead of putting in place the job retention scheme and reopening the economy, do provide visibility, clear, and transparent framework on how things work. And I think that's actually quite interesting road for Europe. The other thing we must take care about is transition support. As support is being withdrawn, and as we remain in this type of transition period where most activities are open, but some remain closed, we're going to see some firms thriving and others will not make it over. Some people, therefore, will lose their job and they have to find a new one. And what we know is the people who run the risk of losing their job in this crisis are the low qualified one. And most governments do not have a very good track record in helping low qualified people transitioning jobs. And I think here there's a lot more that can be done. And the last thing, and I'll be quick because I think Elena will go into this, has to do with corporates. And here it's the same thing. When do you withdraw support and how do you do that? I think one of the key things, especially two principles. One is states, governments are usually not very good to determine which firms are viable or not. We should let the banks do that. They know their firms. And the second thing is, I don't know for how many years the European Commission has pleaded for reforms of insolvency system in Europe. But I think this time we really urgently need a simplified solvency processes so that we can restructure firms and not push them into liquidation because there are too many of them, and that's the fastest way of dealing with them. So that's the second point, and that brings me to the third one and the concluded one. Then there is the huge commitment that Europe has made on strengthening health policy, environmental policy, and also digitalization, meaning infrastructure. And also we've seen the need for better education. So I'm conscious of the time. So just two quick things I would say is we need investment, but the same way that there has been not enough ownership, as Thomas put it, of the fiscal framework. I think there's a lot we can do to improve the governance framework of investment and ensure that actually the money goes into productive investment, because one day citizens will turn back and ask where all the money that has been spent for the crisis has gone. And this has to be accompanied by structural reform. For example, you can build up schools. It's important to focus on teachers training, their ability to deal with digital tools, and how the pupils are equipped and can also learn from there. And the second point is, and that makes the link with Thomas, some countries have had a slight tendency to deficit bias, either for fiscal illusion reason or electoral cycle or common pool problems. So even if we need investment today, I think we need to anchor markets, investors, also citizens and peer countries, and that is especially important in the EU. Peer countries' expectation that this time it will be different. And I think that's why the discussion which is starting in the EU about fiscal framework is so important. Thank you.
Thank you very much, Laurence. That was great. If I be unfair and summarize you in 15 seconds and 4 points, I would say the following. First, in Europe, the state has a much larger share of GDP, between 45 and 57, actually even increasing now. So automatic stabilizers are significantly higher than in the case of the US. That's why the comparison between the US and Europe has to be done much more carefully than it is often done. The second point has to do with your insistence on let's not happen 2010, 2011 again. So don't start too early, or 1937 or whatever you like. What actually happened in Europe in fiscal policy and in the monetary policy domain. The third point was about this should mainly be an effort in helping people to adjust to a new environment, and also to help firms to adjust. And this leads to the issue, who decides on what are viable firms? I know my fourth point, but I won't mention it now because that's exactly the moment where I'd like to bring Elena in, because we've been discussing this issue of how to decide what firms are viable and what not, and how banks should behave very often. Elena, may I ask you to come in?
Yes. First of all, good afternoon or good morning to everyone, and thanks, Hans Helmut, for having me on this panel today. So you asked me, and indeed it fits very well with what Laurence and you were just saying, you asked me to talk a little bit about the effect of the crisis on the European banking sector from two perspectives. One is the increase in sovereign debt that we have seen, which may lead to a new doom loop between banks and sovereign, in the sense that banks may start re-increasing again the holdings of domestic sovereign bonds as we saw in the past. And the second, because corporates had such important liquidity shock, there was an important increase in corporate indebtedness. And what are the consequences of this in terms of insolvency regimes, as Laurence was mentioning, but also importantly in terms of how can we help firms going forward, maybe thinking of other instruments also that are not necessarily that instrument, but also that they are equity instruments. So these are the two aspects: domestic sovereign bonds holdings by banks and the corporate indebtedness that I would like to touch in this brief introduction. So first, let me say, as Laurence already said, the COVID crisis has been a completely different crisis, as we all very well know by now. But for Europe, it has really represented a very different crisis from the financial crisis and the Euro crisis because of the massive use of public intervention, be monetary policy, but in particular be fiscal policy. And on top of it, I think relative to previous crises, there has been a much stronger coordination among authorities, fiscal and monetary, both at the national level, but also at the European level. I think there has been an impressive response to this crisis relative to the two previous ones. Of course, it was somehow easier to respond to the crisis in this way, because this is a crisis which is completely exogenous to everyone and every country in Europe. So somehow it was easier because it was the fault of nobody somehow. But it's fair to say, I think Europe has learned also a lot from the previous crisis, and therefore it was better prepared to any, I think, crisis that may have happened again this time. So given this, let me go to banks. So the banking sector in Europe has started this crisis very well capitalized, or at least much better capitalized than it had started both of the other two crises in the past. And surprisingly, maybe, banks were even more capitalized at the end of 2020 relative to the end of 2019, with a core equity tier 1 ratio that was on average around 16%. This is an astonishing number. Just to give you a comparison, the same ratio was half at the beginning of the financial crisis in 2007. Now, how come that this capital ratio has further increased during the crisis is due to a number of factors. First of all, that there has public guarantees that do not have the same risk-weighted asset for banks as the non-guaranteed loans. But also, because total assets of banks have shrinked a little bit. And this is the negative side, if you want, of this big increase in capital ratio. So starting from the capital perspective, I would say banks are well equipped, have been very well equipped to go through the crisis, and possibly they are also not badly equipped, at least, for the withdrawal of the public measures going forward, but with some caveat. So let me start with the first one that refers to the sovereign bonds. So as both Thomas, but in particular Laurence, has said, of course, the crisis has led to a big increase in public deficit in Europe. Let me say that in 2019, the average government deficit to GDP in the euro area was 0.6%. In 2020, the same number has gone up to 7.2%. So we have seen an astonishing increase. And some countries that Laurence had already mentioned, the ones that were most hit by the crisis, that were the southern countries in particular, also given the high importance of tourism for the local economy, Spain saw a deficit of 11%, Greece of almost 10%, Italy of 9.5%, and even France, it was around 9%. So it has been a big increase, which of course has led also the government debt to GDP ratio massively higher. So for example, just to give you some countries, we have seen Greece going up to 200.5%, Italy almost 156%, Portugal 133%, Spain 120%, or so on. But let me say, overall, there are 14 member states that are above the 60% that Thomas was referring to. So what should be according to the fiscal rules of the European Union. So where have all this debt gone? And in particular, what can we see from the bank perspective? So maybe not surprisingly, we have seen an increase in the bank's holdings of domestic sovereign bonds. So now European banks hold 2.1 trillion of sovereign bonds, with an increase of about 140 billion in the last year. So for example, if I go to countries that are notoriously more prone to this problem, and I'm afraid that this is my country, Italy, we have seen now the exposure of Italian banks to domestic government debt hit a record of 712 billion last August. So let me say this number has been decreasing in recent years since the euro crisis in 2011 to 2013, but it has picked up in the last year. The same also for France. France is exposed for, the French banking sector is exposed for more than 400 billion to the French sovereign sector, and it has been the biggest increase in terms of doom loop, if you want, between banks and the government in Europe. Now, the question that one can ask is, do we have to worry about it? So is this a problem? We have been talking about the doom loop in Europe massively during the euro crisis, and we have tried to really deal with the problem in its roots. So what we see now is something that should worry us again, or is something completely different. And here, let me just give a number of personal considerations. First of all, somebody has to buy this debt. So banks are typically called buyers of last resort. They have been defined this way during the euro crisis, and they will keep always buying sovereign debt once this will increase, because as at the moment with the current situation in Europe, the banks will always be linked to that sovereign, and therefore they will always have an incentive to try to save or to buy government bonds if there is the need to. But having said that, I see this as much less problematic than in the recent crisis. Why? Well, oops, sorry, my telephone started talking. Sorry. So first, it's true, as Thomas said, that the rates will not remain as low as today, maybe for 30, 40 years to go, or for a long period. But it's fair to say that the spreads at the moment are really very contained. The Italian spread versus the German Bund is at today 110 points. As a measure of comparison, the same spread was 500 or 600 even during the Euro crisis. So there is really no comparison with that time. Why is this, despite being the debt to GDP ratio much higher than during the Euro crisis, is for what we have seen in Europe. So for the solidarity that I believe we have seen in Europe with the next generation EU, but not only with this, is also the SURE that Laurence was also referring to when saying the support of employment in Europe that has been very important. But I think it's the signal that this fiscal policy response in Europe has given and gives to the investors and therefore to the financial markets. I tend to agree with Thomas when saying that this is not going to be seen as a permanent facility, but I think it would be wrong not to say that I believe these are the expectations in the market. I think irrespective of now the legal infrastructure and the structure behind the next generation EU, which maybe prevents the possibility from becoming permanent, I think this is seen as a first step towards a stronger fiscal union and the stronger fiscal integration in Europe. And as such, spreads are contained because now it's not just a matter of sustainability of the national debt, but it goes more to a sustainability of the European sovereign debt as a whole. And therefore, the spread remain contained, and therefore also this increase in the sovereign exposure of banks towards the domestic sovereign bonds is, in my view, at the moment, less problematic than in the past. There is no sign of deterioration in the ratings of sovereign. I mean, if I think of Italy, it has been even upgraded recently, at least in terms of outlook, by one rating agency. So the situation is at the moment very calm. I know these are very long-term bonds and we shouldn't be maybe optimistic as we may be now for forever, but the situation currently is very calm, is very stable. So having said that, let me come to the second point, the corporates. So corporate credit picked up significantly in 2020. We have seen a multiple increase in banks borrowing. So we have seen a significant increase in corporate indebtedness. Surprisingly, maybe negatively, this increase in debt has been used by corporates really more as a liquidity buffer against the uncertainty coming with the COVID crisis, and much less in terms of financing investment. So we have seen investment a little bit at halt, and this is not, of course, not very positive, but the emergency was somewhere else. So, of course, it is a big increase in indebtedness raises the question of bankruptcy risk and, of course, of a hampering of future investment. Now, clearly, to which extent is this important for the banking sector? Well, it is because, of course, the bank loans are a big percentage of total assets for the banking sector, and therefore, if there is an increase in non-performing loans, this would be a huge problem. But there is another aspect to that, with differences across country, but many of the loans given in 2020 were actually being given under government loan guarantees, which brings back the issue of the sovereign debt potential increase, because if loans become non-performing, then the corporate would not be called to pay, but the government would be called to pay. And this would significantly increase the domestic debt levels even further. And let me just, as a reference, say that the largest use of government loan guarantees were done in France and in Spain, followed by Italy and Germany. So you see two countries, Italy and Spain, that are already highly indebted, in particular Italy, in terms of government to debt to GDP. So if we really had a lot of increase in non-performing loans, and these loans would be under government loan guarantees, we would have a further significant increase in sovereign debt. So at the moment, what is the biggest worry? The biggest worry is that we have a lot of loans standing there. Many of them are still under moratoria. We have a public guarantee scheme. And once, as Laurence was saying, these measures will be withdrawn because they will be withdrawn going forward. It's very unclear as to what will happen to the level of non-performing loans in the books of the banks. So that is the big question. Banks are, of course, preparing for this. They have set aside provision in 2020. Therefore, at the moment, it's very difficult to understand also what is the level of the non-performing loans. We have seen several countries have already terminated the moratoria. We have not seen big increase in non-performing loans in banks. But this is a very technical aspect. I wouldn't want to touch it here, but very much depends on how many provisions banks were already setting up. So the numbers, I think, are maybe misleading. The positive number that comes currently from the end of the moratorium in various countries, including, for example, Germany. So this remains to be seen. But it is a fact that the level of debt in the corporate has gone up a lot. And this raises the question of whether we can think going forward of financing the corporates in other ways, and in particular through equity type of instrument. But for doing that, as both Hans Helmut and Laurent were saying, and this will be my final words, maybe we can go back more in the discussion, it's very important to understand which ones are the good corporates going forward. And this is a bit of a problem. Laurence said the banks know better than states. I fully agree with this. Banks know their clients much better. I mean, they do credit assessment as their main job still now. But it's also fair to say the shock has been so different from previous shocks that everything that the banks knew about their clients from the past is not necessarily a good indicator for the future. So banks will have to very much change their credit assessment from past history to more forward-looking analysis. And this is a challenge for them. It still will be better than for states, but it's a challenge because they're not used to this type of analysis, and also the information and the data that they have may not always be the appropriate one. And let me stop here and maybe we'll go back in the discussion.
Thank you very much, Elena. We now have so much food for thought. I just take out three. The first one is you highlighted that there was an impressive coordination amongst authorities, not only fiscal policy and monetary policy, but also supervisors and regulators adapted very promptly. So very supportive. The second point you made was about the tremendous increase in public sector debt over GDP and the possible negative ramifications for banks which are heavily invested in this debt. And thirdly, you also stressed that markets are now betting on a much more Europeanized fiscal policy setup in terms of not letting anybody fall by the wayside. So making next generation EU quasi-permanent feature. And finally, what you stressed was about the tricky issue of government guarantees, and some chickens will come home to roost, and how governments might think about being engaged, so equity-like instruments to support firms. I would like to have the three of you interact a bit across the table. Thomas, what do you think of this NPL argument, NPL reasoning? Is this a threat for fiscal policy going forward?
Well, the short answer is yes, undoubtedly it is a risk. How big a risk, that we don't yet know. I mean, Elena pointed out that the sort of accumulated knowledge in the banks about their customers is of limited use in these circumstances, and the same logic applies to the broader assessment that we are making on these risks. The picture is so much clouded by all these measures, by the moratoria, by suspension of practice of bankruptcies and what have you, that that we really lack the sort of a measure of the size of the problem. We know, as both speakers made, Laurence and Elena made clear, that there is an issue, and we need to be prepared. It's part of our work program going forward, trying to collect the information the best we can. There will be more clarity when the temporary measures expire, but I suspect the uncertainty will remain with us. I mean, one kind of uncertainty that will take time to dispel is sort of understanding about the extent to which the issues, the problems we are observing are still a sort of a long tail, transitionary tail of the crisis. How long does it take before we are back to the new normal, and how different is the new normal from the old normal? I mean, these are things that we will only know in over time, and this will crucially affect the need for resource reallocation, the sort of the viability of firms, viability of certain sectors going forward. So I don't want to start quantifying the problem. The head of the single supervisory mechanism gave a number to it. I don't want to repeat it. I don't want to provide my guess, but I mean, it is a sizable issue that we need to deal with.
That's a very important point. Let's assume you're sitting in a Southern European economy where tourism and anything around was about 15 to 20% of GDP. It might not go back to there. So there will be a very significant structural change. And hence it's a long-lasting issue. It won't go, it's not a cyclical thing. It's a reorientation of economies, in addition to anything around climate risk and so forth. Laurence, there's now currently really inflation scare in markets. Rates are going up, and OECD is suggesting to keep continuing with a highly expansionary monetary policy. As a market economist, which you have been, how would you respond?
So I think there's a clear distinction to be made on two dimensions. One is a country dimension, and the other is it's a time dimension. And by the way, I'm super cautious when it comes to inflation, because both Tomasz and Elena, and actually you as well, highlighted the uncertainty, the unprecedented uncertainty surrounding our environment, and that applies to inflation and the reaction of inflation to the reopening of the economy, to the fiscal support, and to the unprecedented monetary policy. We can have a long list of unprecedented here, so that obviously has some impact on how we think about it. And that's why, just to make people smile, my press officer told me, never say that you're not concerned by inflation. This will come back to haunt you. So here we are. In terms of country dimension, what we are seeing is two things. One is in emerging market economies, we are actually seeing some tensions, in food, agriculture prices, some commodity prices, and they're pushing up, they're going up, right? And it's difficult to say how temporary that is, because it also depends on the state of the world health situation. I'll take a very simple example, but for example, all Europeans would probably know that people are not, we have no migrants crossing European border to pick up strawberries, green peas, whatever. And that's pushing the price of food up as well. And it's the same everywhere in the world. When people need to get merchandise or product out of container in harbor, the fact that you have different regulation and quarantine and things like that makes it difficult. Also, digitalization is not just a nice word, but it requires chips and semiconductors and computer, and because everybody wants them now, we have a shortage of those. So there are prices going up. and perhaps for a long, for not permanently, but for a while. And then there is this issue of, there is all this debate about the US fiscal plan, okay? The US American Rescue Plan, that's temporary. So we did something very simple at the OECD. We look at the various components. We look at, what they mean for people when the money would be spent, by whom it would be spent. And all in all, what this gives, which is very similar to other institutions, is you get a very fast recovery. The US is already back to pre-pandemic level. And then it levels off by, say, roughly mid-2022, right? With all the caveats that apply to these projections. So obviously, there will be some tension on the way. There will be higher demand than there is supply in some areas. There will be also people looking for jobs or firms looking for employees and who cannot find them. And perhaps we'll see tension as well. The big question is whether these tensions are temporary or permanent. As of today, there are more indications that they may be temporary, but I think we should be super cautious and monitor, how temporary that is. And we know this is something very difficult to do. It's like looking at asset price inflation or market bubble. You think, oh, the price rise reflects fundamental, or it is slightly higher than fundamental, or it's becoming very high compared to. But it's very difficult to call the right time. So, so to conclude, I think it's a risk that deserves all of our attention. And what's more, it deserves all the more attention that everybody agrees that no, but roughly it should be temporary. We must be something.
Thank you very much. I didn't want to trap you.
Don't worry.
So anyhow, we have a number of questions and I'll throw them at you, and I would like to ask you to come up with very swift, quick responses. The first is, or I'll put a couple of them into one basket. So the first is to Thomas and others. Fiscal capacity at the center level, that's Federico Bonomi. How plausible? Somehow in the same direction, also from possibly an Italian, Paolo Passimini, the balance between the levels of government, who should be in charge of macroeconomic stabilization. And I also include Jonathan Seitlin, whom I know from the literature, I think. Suspension of fiscal rules. Does this now mean a new political logic in the debate? Is there any way to go back to reverse towards old rules? So these three issues I throw at you. Thomas, can you start off?
Okay, thanks. Well, first on the fiscal capacity, it's important to understand that this was quite an achievement to get 750 billion out of the system, and it was connected to the opportunity provided by the fact that we were in the middle of the negotiations on the union's multi-annual financial framework, the 7-year budgetary framework for the union. I would say that it's going to be very difficult to relaunch a discussion of something of similar nature, in a technical sense, difficult, outside the context of the multi-annual financial framework. And the next time we will return to that will be in 7 years' time. Well, actually, we will start the discussions earlier, in 6 years or so. So I don't foresee that happening soon. And then there's, of course, a political issue, that the fact that that we now had the next generation EU will sort of launch certain political debates and judicial processes, including in Germany, that may result in further complications on our ability to do the same. So I would not hold my breath. At this point, I think we should try to put our efforts in making the best we can out of this 750 and see what comes later. On the second, I think this covers the first two questions. I mean, Paolo, by the way, hi Paolo, good to hear from you again. He formulated a question, how should things be arranged? That's a sort of theoretical question. I gave a political answer. I hope he's happy with it. The question of suspension of fiscal rules, I mean, in a way, there has been recommendations, particularly from the European Fiscal Board, to not reinstate the rules before they are reformed. Now, the reality, knowing how things go, is that if there will be a substantive change in the fiscal rules, it will not come easy. It will not come soon. I think it's highly likely to take more time than we can keep the fiscal rules suspended. So I would think the most likely outcome is that that we will reinstate the fiscal rules, but they will be applied highly flexibly, and people will understand that. And then the revised fiscal rule, if they are revised, there's a complete possibility that they will not in the end be revised. The revised rules will enter into force later.
I'm wasting our time by trying to figure out what the other questions are. I have a number of them which I would like to raise. One is to go around the Green Deal and fiscal rules and the very significant amounts which are which have to be put up there. One is the Christina Savescu, and the other about Green New Deal, green and green investment and recovery has been Cevara Vintorini. Could we? Who can take that? Laurence, could you go about this green investment fiscal rules stuff?
I could try. So I think there are two questions in this question. In fact, the first one is what is now, I guess, a little old or long-lasting debate on whether investment in green should find a way as an exemption to fiscal rules. My instinct, not an institutional view, is it should. I don't think it's a good way of implementing the Green Deal. We know how creative governments can be with, public finance accounting, and Tomasz was calling earlier for more transparency and a more open debate about public finances, and I think that's super important. You quoted the CPB and the Netherlands, which is, I think, one of the fiscal board the most open, which assesses nearly, it assesses different parties' political agenda in the run-up to election, and it evaluates the impact of reforms on public finances. New Zealand has the same type of setup, and other countries. And that leads to, I think, much more ownership by the people as well as by policymakers about the objective of their public finance policy. And to me, that's key if we want to have what some people qualified as reasonable public finances. So in my view, when we discuss public finances, there are choices to be made, there are priorities, and this should reflect also the will of the people. And that will be all the more sustainable that people, the ability of people, the willingness of people to pay taxes and to accept the spending is high. And that's probably something that can be strengthened by a more open debate and a more transparent one. And that relates very well to the Green Deal. We know we need some fiscal tools. One question is about carbon pricing. That's raising tax revenues, but that also has distribution effect. It's hurting low-income people and very small firms, which are energy intensive. And also, once you've eliminated carbons, you've also, closed coal mines and so on, and you need to take care of the people who were there, the regions which were living because of this. And that again will have fiscal or public finance consequences. You want to invest in renewable energy, whether it's photovoltaic or others, that will require some public investment. And in Europe, we have the digital grid that will be essential to match the production with the consumption of energy. All these are huge choices with long-lasting implication, because all this infrastructure, they last at least 15, 20, 30 or 50 years. They deserve a democratic debate. So if I was too long, but to me, the topic is not whether this should be exempted or not, is what do we want to do really?
No, you were of course not too long. But now the final and by far easiest questions to Elena. So one is, François Baudu, does Europe have a sufficient investor base to provide more equity to corporates? And what about EU level in terms of substituting equity financing for debt financing? And Graciana Petersen, Graciana is asking, scenarios for NPLs, when will it end?
Okay, let me start with the second one, and then let's go back to the first one. So the scenarios for NPL, I think there will be much clearer once moratoria will be expired. I think now in the last quarter of 2020, the amount of loans under moratoria halved, meaning that in many countries, actually moratoria have expired. So in those countries, there should be already much more visibility of where the borrowers are in terms of credit risk and the ability to repay their loans back. And my understanding, for example, from Germany, is that there has not been a cliff effect. That means that the borrowers have started paying back their loans. Now, clearly, if you remember, as Laurence also had said, Germany had very little impact from the COVID crisis. I think they had a drop of GDP, the drop about 4% of GDP. So it wasn't very significant relative to other countries. I think the bigger test will be Spain and Italy and Greece. These will be the countries where we will really play somehow. We will have to pivotal in understanding how big the increase in NPL can be, and Portugal. I mean, all the countries that have been suffered more from the crisis. But as I said, the first visibility should be at the end of the moratoria. As a sign of optimism, some banks in Italy we still have moratoria. Some banks have even offered to their clients bank moratoria, and clients have not picked that up very much, meaning that clients seems to be able now to get proper loans, or they have enough liquidity. So if we can read this as a positive sign, I think we should. Second question, whether Europe has enough investor base to provide equity to firms, and what Europe has done. So Europe has not done much, is my understanding, at the European level for equity financing. Actually, Hans-Helmut and I, together with other colleagues, had put forward a suggestion to create a European pandemic equity fund. But ultimately, if you remember, this was initially, or some aspect of it was initially incorporated in the recovery and resilience plan that the Commission had initially suggested, but then it was dropped from the final plan, and Thomas can correct me if I'm wrong, it was dropped in the proportion between loans and grants, when Europe had to decide whether how much of the 750 billion would be grants versus loans. that was the moment where this equity fund was dropped from the table because it didn't square with the numbers. And in my view, this was a big pity. What investor base can we use to finance corporates with equity? Well, I mean, governments, of course, but also we can take private funds. With the private funds, there is one issue though. So take, for example, private equity. We would have enough investor base in Europe to finance equity to corporates. But I'm not quite sure that the logic and the way private equity funds normally work would be the right one for providing equity to firms, in particular family firms of SMEs. Why do I say that? Because normally the way private equity fund works, finance a company and then ultimately it would bring the company to be listed. And I'm not quite sure that many of the SMEs, I wonder how many of the SMEs would actually be happy eventually to go public, or for the owners to lose the control of the company. So I think more than what is the investor base and whether that's enough is the equity instrument that we want to use. I think it should be an equity instrument that is not really an equity instrument, but is a form of quasi-equity in the sense that it does not interfere with the governance structure and the ownership of the company. Then it would be a much more successful way of providing equity.
Thank you very much, Elena. I'd be tempted to summarize, and I took so many notes here, about 15 pages, so probably better won't do it. It was just a great event, and I hope it has contributed to the information and judgment building, if you like, of our audience. We will be back with similar events next fall. And the big problem here is, in this case, I would love to have the three of you again around, possibly not a virtual table, but in Lower Conference Hall at 27 Kirkland Street in Cambridge. So thanks a lot for participating. That was very good. And thanks to the audience for also throwing questions at me. When I, by the